wonder if you have ever found yourself in this situation. Whenever the market drops, your portfolio seems to fall even more. But when the market bounces back out, for one reason or another, you always seem to miss out on the gains. Maybe you have a friend like this too. They make money faster than everyone else, but when they lose, it's like they are back to square one overnight. At its core, all these frustrations really boil down to one thing: a misunderstanding of risk. One of the most common mistakes in the stock market is focusing only on potential returns and ignoring the risk involved. We always say, control your risk, manage your risk. But what does that actually mean? How risky is risky? What are we basing that on? Honestly, most investors only have a vague idea, relying mostly on gut feelings. Especially in the market as volatile as this one, it's more important than ever to truly understand risk and how to maximize returns in high-risk environments. Hello everyone, my name is James Lee. Welcome to Stewardship Finance Academy, a channel that builds confident investors. Please subscribe to our channel for more knowledge like this. How do you judge if a stock is risky? Let me ask you something. If I were to ask, is this stock risky? What would you base your answer on? Chances are you might say it just feels risky. But let's unpack that for a moment. What exactly is that feeling? What's driving it? Imagine this scenario. The market drops 1% in a single day, but your stock nosedives 5%. Naturally, your gut reaction might be, wow, this stock is super volatile, and you wouldn't be wrong. In fact, what you are describing is one of the ways we quantify risk. That's even a technical term that explains this behavior. Beta. What is beta and what does it beta? Beta is a measure of how much a stock's price moves relative to a broader market. It's essentially a volatility gauge, and it can give you a clearer picture of a stock's risk profile. And here's how it works. If a stock has a beta higher than 1, it's more volatile than the market. This means it tends to swing more dramatically, both up and down, than the overall market. In other words, it carries more risk. If a stock has a beta lower than 1, it's less volatile and tends to move more conservatively compared to the market. These stocks are typically seen as safer or more stable investments. Let's look at two real-world examples. Over the past year, Tesla had an average beta of 1.78. This means that, on average, if a market moves 1%, Tesla is likely to move 1.78%. That's almost double the market's movement, whether up or down. Meanwhile, McDonald's had an average beta of 0.62. In this case, McDonald moved far less than the market, making it a much more stable stock. From this perspective, Tesla is roughly 3 times riskier than McDonald's, and it's not just perception. Beta gives us an objective way to measure that difference. The best part, beta is easy to find. A quick search on platforms like Yahoo Finance or similar tools will show you a stock beta. With this one number, you can instantly get a sense of how the stock compares to the broader market and whether it aligns with your personal risk tolerance. Here's something most investors don't realize. Major stocks tend to have higher betas than the market itself. That's because a market represented by indexes like the S&P 500 is already highly diversified, which naturally smooths out its volatility. Stocks like McDonald's with a beta below 1 are actually outliers. Most stocks, and by extension, most investor portfolio carry a beta higher than 1. Let's put this into perspective with some historical context. Over the years, the S&P 500 has experienced corrections of over 10% every couple of years, with average pullbacks hovering around 15%. That's not unusual. It's just part of the market cycle. But here's the kicker. If the S&P 500 drops 10 to 15% and your portfolio is packed with high beta stocks, your losses could be far more significant. Take March 2025 as an example. The S&P 500 dips by just 10%, but if you own a portfolio full of high beta stocks, chances are your losses were much deeper than that. This kind of volatility doesn't just live on paper, it lives in your emotions. Watching your portfolio swing wildly can trigger anxiety, fear, and even panic. When volatility runs high, so do emotions. Large portfolio swings can make investors more sensitive to losses, even if the underlying fundamentals of the investments hadn't changed. This emotional reaction often leads to impulsive decisions like selling in a panic during downturns or chasing inflated prices during market bubbles. Here's the bottom line. If your portfolio leans heavily on high beta stocks, you need to be extra vigilant. High beta doesn't just mean more risk, it means more emotional strain, which can make staying disciplined a real challenge. Understanding beta, and by extension risk, isn't just about protecting your portfolio during rough patches. It's about putting yourself in a position to make better, more informed decisions in any market climax. Risk is inevitable in investing, but managing it efficiently, that's a skill every investor needs to master. Let's discuss another powerful tool for measuring risk, standard deviation. If you're serious about understanding and managing risk in your portfolio, this metric deserves your attention. It's one of the most widely used measures in quantitative investing and gives a clearer picture of a stock volatility. What is standard deviation? Standard deviation measures how much a stock's return fluctuates relative to its own average return. In simpler terms, it captures the spread of a stock's ups and downs. How far the actual performance strays from a typical average performance. The bigger the fluctuations, the higher the standard deviation, which translates to higher risk. This makes standard deviation particularly valuable when comparing different investments. Even if two stocks deliver the same average return, the one with higher standard deviation is more volatile and therefore riskier. Why standard deviation matters? Here's a practical example. Let's say stock A and stock B both average 10% annual return. At first glance, they seem equally attractive. However, stock A has a standard deviation of 20%, whereas stock B's standard deviation is only 5%. This means stock A's returns are much more unpredictable and subject to wild swings, while stock B's is relatively stable. Despite their identical average returns, stock A carries significantly more risk. This concept becomes even more critical when constructing a portfolio. Standard deviation allows you to weigh potential rewards against the level of risk you're comfortable accepting. It's a balancing act, maximizing returns while minimizing fluctuations that could wreak havoc on your confidence and sleep. To put this into perspective, let's compare two household names, Tesla and Apple. Tesla's annual standard deviation over the past year was a staggering 84.7%. This means Tesla's stock price could, on average, swing up or down by 84.7% in a given year. Apple's annualized standard deviation during the same time frame was far lower at 24%. So, while both companies are leaders in their respective industries, investing in Tesla was roughly 3 times riskier than investing in Apple over the past year. It's also worth noting that Tesla volatility has been increasing. Its 3-year average standard deviation was 75.5%, meaning that the past year has been even more turbulent than usual. This underscores another valuable use of standard deviation: tracking how a stock's risk evolves over time. How to calculate standard deviation? Standard deviation might sound complex, but it's surprisingly easy to calculate if you're willing to put in a little effort. Here's how. 1. Go to Yahoo Finance or similar platform and download the historical daily price data for the stock you're analyzing. 2. Use Excel or any spreadsheet software to calculate the daily returns, the percentage change in price from one day to the next. 3. Apply Excel's standard deviation formula to the list of daily returns. 4. Voila! You now have the daily standard deviation. To annualize it, multiply the daily standard deviation by the square root of 252, the approximate number of trading days in a year. This process gives you a clear quantitative measure of a stock volatility, which is an essential foundation for making data-driven investment decisions. While standard deviation is an incredible useful tool, it's not without its limitation. One key assumption behind standard deviation is that price changes follow a normal distribution, a neat bell-shaped curve. But as any experienced investor knows, markets don't always behave predictably. In times of extreme volatility or market crisis, price movements can deviate significantly from this assumption. For this reason, it's best to use standard deviation alongside other risk metrics like beta or value at risk. No single metric can capture the full complexity of risk, but when combined, they provide a much more comprehensive view. Understanding standard deviation allows you to quantify risk with greater precision and make smarter, more informed decisions. Whether you are comparing stocks like Tesla and Apple or tracking a single stock's risk over time, these metrics give you a clearer picture of what you are getting into. Remember though, standard deviation is just one piece of the puzzle. By pairing it with other tools, you will be better equipped to navigate the market's ups and downs and build a portfolio that aligns with both your financial goals and risk tolerance. Don't let the math intimidate you. This is about developing an investment mindset that balances risk and reward, rather than fixating on one at the expense of the other. You might be thinking, okay, Tesla is riskier than McDonald's. Does that mean I should avoid Tesla completely or only invest in McDonald's? Not necessarily. Experienced investors don't make decisions based solely on risk or returns, for that matter. They use a powerful metric that marries both concepts. The Sharpe Ratio. What is Sharpe Ratio? The Sharpe Ratio is a formula that helps you evaluate whether the returns that you are earning justify the risk that you are taking. Here's how it works. Sharpe Ratio equal to average portfolio return minus risk-free return divided by standard deviation. In simple terms, it tells you how much return you are getting for every unit of risk you are taking. A high Sharpe Ratio means better risk-adjusted performance. So let's break this down. Imagine Tesla has more volatile swings than McDonald's. Even so, Tesla might still be the better investment if its higher risk is rewarded with proportionally higher returns, resulting in a strong Sharpe Ratio. On the other hand, if Tesla extreme risk doesn't deliver better returns, its Sharpe Ratio will be lower, making it a less attractive investment from risk-adjusted perspective. Here's a real-world example. Last year, the S&P 500 delivered a 12.32% return, while the risk-free rate example, the US Treasury yields, was at 5%. The S&P standard deviation, a measure of how much its return fluctuated, was 15.5%. Plunging this number into a formula gives the S&P 500 a Sharpe Ratio of 0.47. Now, compare your portfolio to that benchmark. Many brokers calculate your portfolio Sharpe Ratio for you, making it easy to see where you stand. For instance, if your portfolio Sharpe Ratio is 1.3, that's considered good or even moderately strong. It means that your portfolio delivers 1.3 units of excess return, which is above the risk-free rate for each unit of risk taken. A solid performance from a risk-adjusted perspective. So what do Sharpe Ratio tells us? Most investments typically fall within a Sharpe Ratio range of 1 to 1.99, where anything above 1 suggests your portfolio is efficiently converting risk into return. If your portfolio Sharpe Ratio is above 2, it's considered very good, and anything above 3 is exceptional. But what if your number is lower than the benchmark? This is where it's time for some honest reflection. Are emotions driving your trades? Are you gambling on speculative opportunities instead of strategically investing? Perhaps you have developed habits that aren't serving your financial goals. Balancing risk and reward isn't just about numbers, it's also about display and perspective. How to calculate your portfolio Sharpe Ratio? Want to crunch the numbers yourself? Here's what you need. Number 1, portfolio average return. Calculate the average return of your portfolio over a specific time period, annually, etc. Number 2, risk-free rate. Use the yield on government bond, example US Treasury bills, for the same time period. Number 3, standard deviation. Measure how much your portfolio return have fluctuated over a period. This tells you how risky your portfolio is. Finally, plug these values into a formula. The Sharpe Ratio equal to the portfolio average return minus the risk-free return and divided by the standard deviation. Example, if your portfolio delivered a 10% annual returns, the risk-free rate was 2% and your portfolio standard deviation was 8%. The Sharpe Ratio would be 10% minus 2% divided by 8% equal to 1. This number tells you that for every unit of risk you are taking, your portfolio is delivering 1 unit of excess return. Here's an important insight. The Sharpe Ratio behaves differently over time. Returns, the numerator, grow linearly over time. For example, a 2% return adds up to a 24% annually, and the risk, denominator, measured as standard deviations, grows with the square root of time. For instance, A 2% standard deviation corresponds to approximately 7% annually. So what does this mean? The longer you stay invested, the more returns stack up faster than risk. This mathematical property is one reason long-term investing is a cornerstone of professional strategies. By holding investments for longer periods, you tilt the odds in favor of higher returns with lower relative risk. Here's the fundamental difference between inexperienced and seasoned investors. Amateurs tend to focus solely on potential gain. How much money can I make? Is this stock going to skyrocket? They obsess over price charts, chasing explosive moves without fully accounting for risk. When the inevitable losses hit, they are often less scrambling to recover. Professionals, on the other hand, ask smarter questions. How much risk am I taking for these returns? Is it worth it? They focus on balancing risk and reward, aiming to maximizing returns without exposing themselves to unnecessary volatility. They may even pass out flashy opportunities if the risk and reward ratio doesn't align with the strategy. Conversely, they will seize boring opportunities that offer excellent risk-adjusted reward. This approach reflects the core principle of investing. It's not about avoiding risk, it's about managing it wisely. The Sharpe ratio isn't just a formula, it's a lens that shifts how you evaluate investments. It pushes you to think like a pro, balancing the thrill of returns with the discipline of risk management. Whether you are calculating it for your own portfolio or using it to compare potential investments, this metric is more than a number, it's a tool to refine your strategies. So, the next time you are tempted to chase the latest hot stock, ask yourself, what am I really risking and is it worth it? Developing this mindset could be the difference between a short-term hype and long-term success. How to raise your portfolio Sharpe ratio? Want to improve your portfolio risk-adjusted performance? The simplest and most effective way is through diversification. But before you dive in, let's clear a common misconception. Owning a lot of stocks doesn't automatically mean you are diversified. So what does real diversification look like? Simply piling up stocks isn't enough. Imagine you own 20 Chinese stocks and a major policy shock hits China's economy. Guess what? All those stocks are likely to tumble together. Or maybe you're carefully picked stocks from different industries, but they're all small cap growth companies or penny stocks. These assets tend to move in sync, exposing you to a significant risk. In this scenario, your portfolio isn't diversified, it's concentrated. If you are taking on all that risk without receiving outsized returns, your risk-reward balance is off. True diversification means combining assets with low correlation. Correlation measures how similarly two assets move, ranging from -1, perfectly opposite movements, to 1, always moving in the same direction. For effective diversification, aim to pair assets with correlation below 0.7. Platforms like Portfolio Visualizer can help you analyze correlations between stocks, ETFs, mutual funds, and other assets over customizable time period. These tools provide correlation metrics and visualizations, making it easier to identify low correlation combinations. Want to explore these tools? Visit our website or follow the link in the description. We have compiled a list of great free resources for investors, including the Portfolio Visualizer. These recommendations are purely educational. We don't receive commissions or have affiliations with any of the businesses. Our goal is to simply empower our audience and with accessible tools to build smarter portfolios. One of the best examples of proper diversification is Ray Dalio's all-weather portfolio, managed by Bridgewater Associates. Dalio's strategy focuses on assembling assets with the lowest possible correlation, ensuring stability in any market condition. Over the past 25 years, this portfolio has delivered 30 annual returns of 6%, not far behind the S&P 500 9.96%, but with volatility between 10% and 12%, significantly lower than S&P's 15%. This lower volatility means better risk-adjusted return, which is the hallmarks of high Sharpe ratios. For a cautionary tale, consider Cathie Wood's ARK funds. While her funds hold dozens of stocks, most are high-growth tech names, assets heavily exposed to sync. When something disrupts that sector, like interest rate hikes, the whole portfolio tanks together. This lack of diversification results in a portfolio that's highly volatile and vulnerable, with Sharpe ratios that fall short of expectations. Another effective way to raise your Sharpe ratio is the core satellite strategy. Here's how it works. Start with your core holdings. Make a broad market index funds like an S&P 500 ETF your portfolio anchor. Index funds provide maximum diversification, excellent risk-reward ratio, and a stable foundation for your Sharpe ratio. As Warren Buffett famously advises, if you don't know what to invest in, buy the S&P 500. Even after countless efforts, most investors fail to outperform the S&P 500 over time. It's an unbeatable baseline for most portfolios. Then you add satellite picks. Once your core is in place, sprinkle in a few high-conviction investments, assets you believe have the potential for extra returns. This could be emerging market ETFs, individual stocks, or sector-specific funds aligned with your outlook. The key is moderation. These satellite bets should enhance your returns without significantly increase your portfolio exposure to risk. And why these strategies work? By anchoring your portfolio to a diversified index fund, you ensure a strong baseline for risk-adjusted returns. From there, adding targeted plays allows you to customize your portfolio without jeopardizing the balance between the risk and reward. This structured approach does wonders for your Sharpe ratio, helping you optimize performance while staying disciplined. Boosting your Sharpe ratio isn't about chasing high-risk opportunities or loading your portfolio with trading stocks. It's about smart diversification and deliberately managing the relationship between risk and reward. Whether you're analyzing correlations, following a core satellite strategy, or learning from the successes of seasoned investors like Ray Dalio, the goal is the same. Design a portfolio that works for you, not against you. So the next time you're reviewing your investments, ask yourself, is my portfolio truly diversified? Am I balancing risk and return effectively? These questions are critical to raising your Sharpe ratio and ultimately building a portfolio that delivers results in any market climax. Does diversification kill returns? You've probably heard it before. Diversification waters down your return. Maybe you're thinking, I want to make big money and I'm okay with the risk. Why bother with all this Sharpe ratio and diversification talk? Here's the thing, these mindsets might feel boring, but it's actually short-sighted. Even if you're a risk taker, understanding risk-adjusted metrics like the Sharpe ratio is essential. Why? Because taking risks for the sake of risk isn't the same as taking smart risks. Let's say you have two investment options. Number one, investment A, triple the potential returns, but with 3 times the risk. Number two, investment B, double down the potential returns with only half the risk. At first glance, investment A might seem like the obvious choice if you're chasing high returns, but what if you use leverage? If you choose investment B and apply 3 times leverage, your return will match investment A's, but with only 1.5 times the risk, not 3 times. This means you're taking on half the risk for the same reward. Even the most aggressive investor would agree, doubling down your risk unnecessarily isn't a smart move. This is why saving investors prioritize risk-adjusted returns over raw returns. It's not about avoiding risk altogether. It's about ensuring every unit of risk you take is justified by the reward. If you're aiming for higher returns, don't fall into the trap of chasing the next hot stock speculative rocket start ride. These opportunities often come with uncontrollable risks, the kind that can wipe out your gains or worse your portfolio. Instead, focus on investments with strong Sharpe ratios, high risk-adjusted return. Once you identify this, you can size up those positions intentionally, even adding leverage if aligned with your risk appetite. Of course, no single metric should dictate all your decisions. The Sharpe ratio is no exception. Even if an investment has a stellar Sharpe ratio, there should always be a risk rate line, a point where you draw the line no matter how good the numbers look. This is where value and risk becomes crucial. Value and risk helps you answer one critical question. What's the worst case loss my portfolio could face over a given time period? With a certain level of confidence, for a one-day VAR of 100,000 at 99.5% confidence means there's only a 0.5% chance that your portfolio will lose more than 100,000 in a single day under normal market conditions. It's important to note that VAR doesn't predict what will happen. It simply quantifies your potential downsides so you can make informed choices about your risk tolerance. Some brokers even calculate VAR for you, So how to use the VAR effectively? Number one, set your comfort zone. Determine how much you are willing to lose in a single day. This is your personal tolerance threshold. Number two, de-risk where necessary. If your VAR is too high for your comfort, consider reducing leverage, trimming risky position, or diversifying further. Number three, takes advantage of low VAR. On the flip side, if your VAR is too low, it might indicate that your portfolio isn't fully utilizing its earning potential. In this case, you could consider adding exposure to higher return assets within your risk limits. At the end of the day, risk management is the backbone of successful investing, no matter your goals, risk appetite, or strategy. Metrics like Sharpe Ratio, VAR aren't designed to limit you. They are tools to help you make smarter, more calculated decisions. But here's the truth. The world isn't short on investment tools. It's short on the right mindset. Learning to think about risk is a skill every investor needs to master. It's not about avoiding risk, nor is it about diving headfirst into every high return opportunity. Instead, it's about calibrating your decisions, balancing risk and reward with precision so you can build a portfolio that aligns with your long-term goal. My mission isn't to make you rich. I don't have that power. My goal is to help you invest with a greater confidence and peace of mind. If you can approach your portfolio with clarity, control, and a Sharpe Ratio perspective on risk, then I've done my job. If you ever found this content useful, I invite you to take your learning to the next level with our free stock investment masterclass. It's available for a limited time, so don't miss out. Sign up now using the link in the description before the offer expires, and it's free. If you have made it this far, I appreciate your time and attention. Give yourself a thumb up. Don't forget to like this video before you go. It really helps to reach more people who will benefit from this content. I'll see you in the next video. Until then, invest wisely and take care.